Welcome back to the deep dive. We're doing something a little bit different today. We're essentially time traveling. We have the Netflix Q4 2025 earnings report in front of us. It's dated January 20, 2026. And honestly, reading this feels like a transmission from another planet compared to, where the media industry was just a couple of years ago.
Oh, it really does. I mean, if you thought the streaming wars were just about who had the best shows, this report is a huge wake-up call. It basically says the war is over and we're building a new empire on the ruins. Because the Netflix we're looking at here in 2026, it's definitely not just a streaming app anymore.
No, it's morphing into something else entirely. We're not just talking subscriber counts. We're talking about Netflix buying one of the oldest movie studios in history. We're talking cloud gaming live events.
A company that seems to want to own every second of your free time.
Exactly. So our mission today is to unpack this document. We need to figure out how Netflix plans to hit, $51 billion in revenue this year, and why this report suggests the line between going to the movies and watching Netflix is, well, basically dead.
That is the headline, for sure. But to understand the big flashy stuff, the acquisition, which we will get to, you have to look at the cash register first. Because the numbers they put up for the end of 2025 were just absolutely massive.
Okay, let's start there. They beat expectations, right? Pretty much across the board.
They did. Revenue came in at $12.05 billion for the quarter.
And Wall Street was looking for about $11.97 billion.
Yeah.
I mean, that's a lot of money, obviously. But does a slight beat like that really matter at this scale?
It does when you look at the growth rate. That $12 billion represents a 17.6% year-over-year jump.
Okay, contextualize that for me. Because in tech, you hear about startups with 100% growth. 17%. It doesn't immediately sound like hypergrowth.
True, but you have to remember where Netflix is in its life cycle. This is a mature company. I mean, they're in completely saturated media market. Everyone who wants Netflix effectively has it. So for a company this big to still be growing nearly 18%, that's incredibly difficult. It tells you they have serious pricing power and that their new revenue streams are actually starting to work.
And they squeezed out an earnings per share and EPS of $0.56. That beat the consensus by a penny. Again, a penny beat usually gets a shrug. And I see here the stock actually dipped a bit in after-hours trading before it stabilized. So why the hesitation if the numbers are so good?
It's indigestion, pure and simple. The market is just staring at this report and trying to digest two massive transformative shifts. One is this ad boom and the tech driving it, and the other is, the elephant in the room.
The Warner Bros.
The massive pending acquisition of Warner Bros. Studios and HBO.
Which is still just mind-blowing to me. Netflix buying HBO feels like Pepsi buying Coke.
Or Amazon buying a bookstore chain, which
Right.
I guess they did.
Right. But before we get to the merger, let's look at how they're paying for it. The guidance for 2026 is bold. They're forecasting $51 billion in total revenue. That's up 14%. Where is that extra cash coming from? Are they just hiking prices again?
That's part of it, but the real engine here is the ad tier. They're projecting the advertising business will double in 2026. It's going to hit roughly $3 billion.
That's serious money. But I remember when they launched ads, everyone was worried it would cannibalize their own business. People just downgrading to the cheaper plan.
That was the fear. And management was pretty candid about this on the call. They admitted there's still a gap in revenue between what they make from an ad tier subscriber versus a full-price standard one. The ad money wasn't quite making up for the lower subscription fee.
Right, but they're saying that's changing.
They claim that gap is narrowing fast, and the reason is something they called modular capabilities.
I circled that phrase, modular capabilities. It sounds like classic corporate speak. What does it actually mean for me sitting on my couch?
It sounds boring, but it's actually kind of fascinating and maybe a little creepy. It's rolling out globally by Q2 2026. Think of it as programmatic creative.
Okay, break that down.
So traditionally, an advertiser makes a 30-second car ad. They film it, they edit it, and that's the file. Everyone sees the same ad. Modular capabilities means the advertiser provides a bunch of different pieces, different music, different voiceovers, maybe different shots of the car. And then Netflix's system dynamically assembles the ad in real time based on who is watching.
Wait, so the ad is being built on the fly? For me specifically?
Effectively, yes. If the algorithm knows you respond better to high-energy rock music, it builds that version. If it knows I respond to a calm voiceover and safety features, it builds that one.
That is impressively dystopian.
It's efficient. And if they can prove to advertisers that their ads are hyper-targeted to your brain, they can charge a massive premium. That's how you get to that 31.5% operating margin target they've set.
So they're not just selling eyeballs anymore, they're selling psychological targeting.
That's the game. And they need those high margins because despite the profit, they do have some drag on the balance sheet. They noted a 0.5% margin drag just from the costs of the Warner Bros. Merger.
Which brings us neatly to the Blockbuster deal, the strategic accelerant, as they call it. For a decade, Netflix was the disruptor, the barbarians at the gate. Now they're buying Warner Bros. And HBO.
Yeah.
Why? Why buy a legacy studio?
It really comes down to two things, IP and prestige. In the report, they explicitly mentioned the prestige factor of HBO. They know the Netflix brand means volume, it means something for everyone. But the HBO brand, that means quality, it means awards. They want that badge.
Instant credibility.
Exactly. But there's also the financial logic. They talked about pro forma alignment.
Translate that for us.
It's just accounting what-if scenarios. They're saying if we combine the companies today, right now, 85% of Warner Bros.' revenue would fit perfectly into what we already do. It means they're not buying some messy conglomerate with, like, theme parks or cable lines they don't understand. They're buying a content machine that plugs right into their distribution machine.
But here's the part that just contradicts everything Netflix used to stand for. The theatrical pivot. I remember them refusing to release movies in theaters, fighting with Cannes, with the Oscars. Now, this report says they're keeping Warner Bros. Theatrical distribution business.
This is the aha moment for the entire industry. For years, Netflix avoided theaters because building a global distribution network is a nightmare. It is expensive and it's risky.
It's a logistical headache they didn't want.
Exactly. Ted Sarandos, the co-CEO, was very clear. He basically said, look, we debated building a theatrical engine for years. It was too resource intensive, but buying a machine that is already working, that makes sense.
So they're not building it from scratch. They're just inheriting a turnkey operation.
Inheriting a scaled, world-class theatrical distribution business worth over $4 billion in box office revenue, that's not chump change.
So does this mean the windowing war is over? Are they actually going to let movies be in theaters exclusively?
Yes. They've committed to maintaining the 45-day exclusive theatrical window for Warner Bros. Films.
That is a massive philosophical shift. Netflix is now a theater owner. But hold on, this has to be setting off alarm bells in Washington. Netflix plus HBO plus Warner Bros. How is that not a monopoly?
Oh, it's definitely risky. But the co-CEOs have a very specific, very calculated defense prepared. And it's fascinating because it relies on throwing other tech giants under the bus.
Also,
Their argument is about defining the market. If you define the market as paid TV streaming, then yeah, this looks like a monopoly. But they're arguing that the market is human attention.
the attention economy argument.
Right. They cited YouTube, Amazon MGM, social media. They pointed out that YouTube has now surpassed major broadcasters like the BBC in total viewership. Their argument to regulators is basically, look, if you stop this deal, you aren't protecting consumers. You are just handing the future of video to Google and TikTok. We need this scale just to survive against big tech.
That is a savvy pivot. Don't look at us, we're just a TV channel. Look at the guys with the algorithms.
Precisely. We're the underdog fighting the tech giants, says the company worth hundreds of billions of dollars.
It might just work. Okay, let's talk about what we're actually going to be watching in 2026. The report says the slate will be smoother than 2025. What does that imply?
Apparently, 2025 was very back half weighted, meaning subscribers had a dry spell for 6 months and then got hit with everything in Q4. That creates churn.
People cancel in March and sign back up in November.
Right. So they're promising a more consistent drip feed of content in 2026 to keep people locked in year-round.
And looking at this list, it's a stacked deck. We've got Bridgerton Season 4, The Night Agent Season 3. Beef is coming back for Season 2, which is huge.
It's a lot of what you'd call retainment content. Shows we know people love, returning hits, reduce risk. But the new stuff is interesting, too. The Duffer Brothers, the guys who made Stranger Things, are launching 2 new series, one called The Burrows and another one titled Something Very Bad Is Going to Happen.
I'm watching that just for the title alone. It works.
It does work. They're also doing a modern Pride and Prejudice and doubling down on global content with a K-drama, Can This Love Be Translated? They know that K-content drives huge engagement.
And on the movie side, since they're a theatrical studio now, are we getting blockbusters?
Heavy hitters. A Peaky Blinders movie with Cillian Murphy, Greta Gerwig's Narnia is finally landing, and a sci-fi thriller called Apex with Charlize Theron.
And I saw mention of a heist film.
Yes, Here Comes the Flood, starring Denzel Washington and Robert Pattinson.
Denzel and Pattinson in a heist movie. That sounds expensive.
It is. But that's the prestige play again. You need those big star vehicles. But notice what else they're doing. They're not just relying on their own stuff, they're pivoting back to licensing.
Right, I saw that. New deals with Sony and Universal.
And Paramount. They signed a deal to bring Paramount series to Netflix that have never been there before.
Which is interesting because a few years ago, all these studios pulled their content off Netflix to start their own services. Now they're selling it back.
They realized that building a streaming service is hard and often unprofitable. Netflix has won. So now Netflix is becoming the aggregator again. They want to be the home for their own hits and everyone else's.
So the strategy is make your own hits, buy Warner Bros. To get their hits, and then rent everything else. Be the everything app for video.
And for audio. And for gaming. This brings us to the ecosystem play. They are trying to stop you from ever leaving the app.
Let's look at live events. They've done over 200 of them now. Is this still an experiment, or is this a real business?
No, it's a pillar now. They have the global premiere of Star Search coming up with live voting.
Taking a shot at American Idol.
Directly. And they're expanding sports with the World Baseball Classic in Japan. The insight here isn't just sports rights, it's about urgency. On demand is great, but it doesn't create FOMO, that fear of missing out. Live events force you to open the app at a specific time.
Right, you can't spoil a scripted show if you watch it a day late, but you can definitely spoil a baseball game.
Exactly.
Now, gaming. I feel like we've been hearing Netflix is doing games for years, and it was mostly like solitaire on your phone. This report feels different.
It is different because of the cloud-first shift. They're finally moving games from the phone to the TV. You don't need a PlayStation, you just stream the game like a movie. They're touting titles like FIFA and Red Dead Redemption.
Red Dead is a massive, complex game. If they can stream that with low latency, that's a huge technical achievement.
They claim performance is comparable to GTA, which did well for them, but honestly, the most revealing part of the earnings call wasn't about high-end graphics, it was about Boggle.
Laughs. The Boggle anecdote. I loved this part.
It was such a rare human moment. Spencer Wang, the VP of Finance, was asked about the gaming strategy. And he sort of sidestepped into this story about how he refuses to play Boggle against co-CEO Greg Peters.
Because Greg is too good.
Apparently, Greg plays with his family constantly and just destroys everyone. He's a Boggle shark.
I just love that image. Titans of industry negotiating billion-dollar mergers, but getting genuinely competitive about digital Boggle.
It's funny, but it highlights their strategy. Party games. Games you play on the TV using your phone as the controller. It keeps the whole family in front of the Netflix screen together. It makes Netflix the hearth of the home.
And to round out the ecosystem, podcasts. Video podcasts are officially a go.
Yep. Partnering with Spotify, The Ringer, Barstool, they're calling them modern talk shows. But the strategy isn't to have one giant exclusive hit like Joe Rogan. It's volume.
It's filling the gaps.
Exactly. You watch a movie maybe once a week. You might watch a 30-minute sports podcast every single day. It builds a daily habit, and habits reduce churn.
Speaking of churn, let's look at engagement. 2 billion total view hours in the second half of 2025. Up 2%.
Yes.
Is 2% good? It feels a little flat.
It is steady, but management spent a lot of time trying to retrain investors on how to read that number. They argued that hours viewed is becoming an imperfect metric.
How so? Isn't more watching always better?
Not necessarily. They gave the example of Japan. Japanese viewers culturally watch about half as much TV as Americans. They just don't sit in front of the screen for 4 hours a night. So as Netflix grows in Japan, their average hours per member might actually go down, even though the business is booming.
So they're shifting the goalposts.
They're pivoting to fandom as the currency. They care more about quality engagement than raw hours.
Explain that distinction.
Okay, so if I leave the TV on for 5 hours while I cook, that's high hours, but low engagement. I don't care what's on. But if I watch 1 hour of Stranger Things, then text you about it, buy a t-shirt, and play the game, that's fandom. And fandom reduces churn much better than passive viewing.
That makes sense. You don't cancel something you're a fan of. You cancel something that's just background noise.
Exactly. And they reported that customer satisfaction is at an all-time high, so the fans are happy.
So if we pull back and look at the whole picture, Netflix in 2026 is a TV network, a movie theater chain, a high-end gaming console, a podcast player, and an advertising juggernaut.
They're trying to be the operating system for your leisure time. That is the ambition.
And that explains the Warner Bros. Deal. They looked at Amazon, Apple, Google, and realized that to win the battle for total attention, just being a streaming app wasn't enough. They had to be an ecosystem.
It's a massive gamble. Buying a legacy studio is heavy, getting into theaters is heavy.
Hmm.
But with $51 billion in revenue, they have the cash to make the bet.
They certainly do.
Yeah.
But I feel like there's a philosophical question lingering here.
There is. And it's the thought I want to leave you with.
Go ahead.
If Netflix owns the movie theater, and they own the streaming service, and they are protecting the theatrical window, does the war between cinema and streaming finally end?
Because they're on the same team now.
Exactly.
Yeah.
Think about it. Is the movie theater just the premium tier of your Netflix subscription? You pay $15 to watch at home or $20 to watch it at the Netflix cinema.
That is a brain bender. It's like paying extra for 4K.
It feels like we're moving toward a world where the distinction between cinema and streaming isn't a battleground anymore. It's just two different rooms in the same house.
The theater isn't a competitor, it's just an upsell.
Just an upsell.
Well, on that note, I think I need to go update my subscription. Maybe practice my Boggle skills just in case. Thanks for listening to this deep dive into the new Netflix. Watch this space, because 2026 is shaping up to be a fascinating year.
See you next time.